said that we could come back to why this environment has been has sort of deflated all risky assets and how it's been impossible for a diversified long-only portfolio to preserve returns this year. And I think it's worthwhile visiting this idea as well. So maybe walk us through how that works.
Yeah, I mean, I think that's by far the most important thing that's been going on. In December 15th, Jay Powell had a short phrase in his press conference after the Fed meeting of that day and mentioned that they're looking at the balance sheet. And it was really just as innocuous as that. And I immediately tweeted that was a game changer. It was not anticipated, and I'll tell you why. And it was a game changer. December 29th, I wrote the drum beats of QT, which was my piece about what the impact on financial markets would be when QT started. And at the time, it still didn't seem to matter. Asset prices had rallied almost through that date, really just a little tail off in December, but really just an incredibly robust environment for all assets. But then the minutes came out on January 4th and the world woke up. And from then on, all we have seen is front running of quantitative tightening. And that's because quantitative tightening will result in the need for financial markets to absorb bonds that the Fed would have otherwise bought from the US Treasury. And that'll start in June 1st. And so quantitative tightening has done nothing to hurt assets either December 15th or January 4th, because it hasn't even happened. In fact, the first quarter, there was still quantitative easing through mid-March. And that's actually buying bonds from the market, from the Treasury, that they would have otherwise had to sell. And that's, that was going on. So all of this has been front running. And what I mean by that is that in the world, you can collect essentially free money by letting somebody, if you have savings, if you have dollar savings or any currency savings, and somebody wants your dollar to consume or to invest in the real economy, they will issue a security. And for that security, you're taking risk. And you need to be rewarded for that. It's like, is there any incentive if somebody comes up to you and says, I'm going to flip a coin and pay you a 50-50, and we'll do a 50-50 payout. And you have the money, and they want half of your money, either all your money, or they'll give you twice your money. You don't have any incentive to do that bet. There's no economic incentive to just bet without positive expected return. And so when somebody asks you for your cash savings, they need to compensate you for that. And that is through what we call risk premium. And all investments have it. Stocks, bonds, commodities, currencies really don't.
Real estate.
Except emerging markets. And yes, real estate, all assets, anything that people will give you for your money that is an investment for you. Pay you a risk premium just if you hold it. What people forget is that that risk premium that you collect each day can be also mark to market, meaning in certain environments the risk premium you can receive is high, and in other environments the risk premium you can receive is low. And so that fluctuation can have a big impact on asset prices. So when do risk premiums contract? Well, they contract when, for instance, you have quantitative easing, in which the Fed is buying assets in the marketplace, and they're competing with everybody else who has savings for these assets. And so there are less assets available to buy because the Fed's bought some. And that inflates assets prices. And that inflation is seen in essentially the contraction of what you would expect to earn from beta. And so that's what's happened since quantitative easing started in 08, 09, and then rapidly happened with a massive quantitative easing that started in April of 2020. And so that's coming to an end. Risk premiums need to expand because people need to be rewarded more to lever up their own risk to take on the US Treasuries that the government is selling that the Fed isn't buying anymore. And so that's really what this whole thing has been about. People think about the path of interest rates, the hiking of interest rates. It really hasn't been about that. It's just been getting set for what is going to be a supply and demand imbalance between those who have money and credit to invest, and those who need money and are selling those investments. And I think that's really all that's happened in the last. And so, what's happened? Every asset has gone down since then.
Because global risk premia have needed to expand because in anticipation of having to absorb either, at some point, maybe even flows from the Fed into the market, but at the very least now from the Treasury into the market because the Fed will no longer be absorbing the Treasury issuance.